Hello, my name is Joe Hoyle, and I am the author, one of the co-authors of Financial Accounting, which is the textbook that you're using, and we're going to look today at Chapter 1. This is a review question to help you get all of the material that we've covered in Chapter 1 under better control. In this problem, you have a company, Delightful Donut Corporation, and we're going to call it DDC for short, and they issue 100,000 new shares of capital stock. One investor, Susan Smith, has looked and studied the company and has made the decision to buy 1,000 shares of DDC's capital stock. So we want to look at four different terms here to get a better feel for financial accounting. What we're going to do first is look at the term corporation. DDC is a corporation. A corporation is a separate legal entity that's created by the state government. It cannot be created simply by yourself. You have to go to the state government. If you're in Wisconsin or Maine or New York, you go to the state government and they give you the things that you have to do to become a corporation. Now, there's a very big advantage in being a corporation, and that is that the ownership, let's say this is all of the owners of the business, the ownership is separate. We sometimes say that there's a veil of incorporation between the corporation and the owners, and that serves to protect the owners. They can lose their investment, but they cannot, under normal circumstances, lose more than their investment. So people are much more inclined to put money into a corporation because the amount that can possibly lose is well defined. So if you're looking at creating a business, if you create a corporation, what you can do is get more and more and more owners. And as you do that, the business will get larger and larger and larger. That's the reason that all major businesses are corporations. It's that ability to get more and more owner and to get money from selling capital stock that allows the corporation to function as it does. Our second term that we're going to look at is going to be capital stock. I mentioned in the previous slide that what we were doing is to have a separation of the ownership from the corporation. So we'll put the corporation here and we'll put the ownership up here. And what happens is that there has to be some way to identify ownership. So the ownership is divided into pieces. And each of these pieces is called a share of capital stock. Now we'll learn later that there's two types of capital stock. There's common stock and there's preferred stock. But for the time being, we're simply going to refer to this as capital stock or ownership. So if you want to be an owner, if Susan Smith wants to be an owner, she has to get at least one share of that capital stock. Now, a question is, if you buy a share of capital stock, what good does that do you? Well, remember we said that the state government allows you to become a corporation, or allows a business to become incorporated. The state government specifies what the ownership of capital stock does for you. However, in most businesses, there are two things that are very important for a corporation. One is that they can receive dividends. A dividend is a distribution from the corporation to the ownership. So if you have 10 shares of stock, then you get 10 of those dividends. If you only have one share, you get one dividend. So that's one way you benefit from a corporation. The corporation gives or distributes a dividend to the owners. The other is, and this is for most corporations, but not all, you can buy and sell your stock. That's what happens on the New York Stock Exchange. The ownership shares are sent from one owner to another. So at some point, Susan Smith might decide that she's had the ownership long enough and she will go and try to find an owner. So let's say she finds John Doe and she sells the shares to John Doe. That allows you the ability, you hope, if the corporation gets larger, then what you hope is those shares of stock become more valuable and you make money by selling it at a higher price than what you bought it. So you benefit by dividends and you benefit by the possible buying and selling of the shares and selling them at a higher price than when you bought them. Our third group of terms here is financial accounting versus managerial accounting. It says in the problem that Susan Smith looked at the financial information. So here is your corporation, and what is the difference in financial accounting and managerial accounting? Managerial accounting probably is easier to think about. Managerial accounting is when information is sent inside of the company, and it can be sent to thousands of people for them to make a decision. So if the question is, should you open another store? That's an internal decision that would use managerial accounting. If you say, what kind of donuts should we sell? Or how much should we sell the donuts for? Or how much flour should we put in donuts? Those are all internal decisions and they use managerial accounting. Financial accounting, on the other hand, is where the corporation sends information about itself as a whole. Now, obviously, it shows the parts of information, but the whole idea of financial accounting is to describe the business as a whole. You typically have decision makers outside the corporation who want to look at this corporation, and it's this financial accounting information that allows that. As it says in the chapter, decision makers typically are in two kinds. One are people who want to buy stock or sell stock, like Susan Smith, who want to become an owner or get out of being owner. The others are interested in possibly giving a loan or credit to a corporation, and they are trying to decide whether the corporation should have money lent to them in this case. If you buy stock, as Susan Smith is thinking about doing, you're hoping to get dividends and you're hoping to get stock appreciation. Those are the two things that you want if you are looking to be a stockholder in this case. The information goes to the decision maker, and that decision maker can make a decision about the corporation as a whole in that case. Now, our final term then is financial information. I have mentioned that the corporation is going to send information to outside decision makers like Susan Smith. The whole course here, the whole book of financial accounting is about this financial information that's being sent to these outside parties. What makes up that information? Well, that's what the course is really about. We want you to be a great, wise decision maker. And you're only going to be an excellent decision maker if you understand the financial accounting information that you're getting. At this point, I simply want to mention two things. One is that the information has to be monetary. Financial information for accounting purposes is always stated in terms of dollars. And secondly, where possible, accountants love information that's objective. And objective means it can be proven. Accountants sometimes have to use guesses and estimations, but they really prefer objective information. The other thing I want to mention about this financial accounting information is really that it looks and shows you about the past. And it's going to describe what's occurred in the past. But what it really wants to do is to help you determine what's going to happen in the future. If, for example, you're going to consider buying a share of stock, what you're interested in is what is the possibility in the future that we will be able, or that corporation will be able to pay a dividend, and what's going to happen to the stock price in the future. If you look at the past and you analyze the past by looking at this financial information, then you can make these kinds of decisions. What is the future going to look like? Is this going to be a growing corporation that's going to pay lots of dividends and have a stock price go up so that I should buy it? Since Susan Smith bought this corporation, it's clearly a sign, bought 1,000 shares, it's clearly a sign that she felt that this financial accounting information, this monetary and objective information, indicated a bright future for the DDC, or the Delightful Donut Corporation. Financial accounting helps you become a great decision maker. And it helps you to make wise decisions by providing financial information. But it's talking about the corporation as a whole. My name is Joe Hoyle. I'm delighted that you're with us. I hope this turns out to be the greatest course you've ever had.